Hello, everyone. Thanks for joining tonight. My name is Debbie Schwartz. I'm the founder of Road to College and the Paying for College 101 Facebook group. I'm here tonight with Chris Abkarians. He's a co-founder of a company called Juno, and he'll talk more about what Juno does. But tonight we're going to focus on helping you understand some important changes that are going to go into place relating to federal student loan and federal parent loans that will go into effect this July 1st, 2026. It is part of what was passed as part of the Big Beautiful Bill this past summer, and it's really important for all families to understand what these changes are because they absolutely impact how you'll be able to pay for college. But before we get started, if people can just if you want to share in the chat where you're watching from, and particularly what year in high school or maybe college you have a student, that would be really helpful. I'm asking you to do that just to make sure that our chat is working properly tonight. So we have a chat and a Q&A. Oh, good, it's working. So feel free. It's probably easier if you don't mind. You could put questions in the Q&A, but also feel free to put comments, anything else you want to say in the chat. We'll be watching both. So nice to see people from all different parts of the country, and looks like we've got a lot of seniors, some juniors, which I think is great if you're here and you have a junior in high school. It really is important. I don't know if you've been reading my emails for your junior class people that I've been emphasizing it's important to understand these changes as you think about building your students' college list. So I'm glad you're here tonight to learn more. And we will get started. I know that Chris has a lot of good information and want you guys to have a chance to ask questions. So, Chris, I'm going to pass it to you, and I will watch any questions that people have and maybe interrupt you. But we've done this a few times over the past few years, so I think you guys will get a lot of information out of tonight's presentation.
Thank you very much for the intro, Debbie. Thank you, everybody who's here this evening. Just quick background. I'm Chris Abkarians. I'm one of the founders of a company called Juno that's worked with, at this point, I think several hundred Road to College Facebook group members over the years. And I'm going to give you just a quick background on how this works. I started Juno 7 years ago because I was looking at my federal loan options, and one of my classmates and I were unhappy with the rates that were available to us. So we decided to try an experiment to see if we could bundle together 500 of our classmates who all needed to get a loan for grad school at the same time. We formed the group, we reached out to a lot of different lenders, and we asked if they would negotiate on the rates and terms that they would give to our group. A lot of them said yes, and that experiment was successful. That's how Juno started. Today, we effectively run the same concept for over 200,000 people so far, where each year, between up until May 1st, we ask people to sign up to a negotiation group. It's free to sign up, doesn't obligate you to do anything. All it really does is say, this is the year that I think my student is going to graduate from college. We use that to basically pull together, let's say 10,000 people who are incoming college freshmen, and present the total size of that group to different folks in the market to say, can you do something better for these 10,000 people than you would do if they came to you one by one? And then we make that available to people on June 1st of each year, the results of whatever we've been able to negotiate. And so as you do learn more about what the changes in federal lending look like and the reasons why more people may need to start exploring private loan options, I only ask you to do two things. One, shop around if you do end up needing a private loan option. And two, just check what's available to you through Juno at some point of that shopping around experience. Shopping around is maybe the most important thing to do. Just give us a chance to show you what we can do in that process. So this is the first time I'm actually walking through this set of slides, and I'm hoping that we can have a really robust conversation around the way that the new federal loan changes are going to impact both undergraduate students as well as graduate students. Well, let's just go through a little bit of the agenda first. I'm going to give you a really quick summary of what these federal changes actually are, and a really quick version of the ways that you can avoid these changes in specific circumstances. This is going to apply to not all that many people on this call, but some people may be able to avoid these changes. I'm going to go through a section that gives you a lot of the key information you should understand about how these changes are going to impact parents of undergraduate students for the upcoming year and beyond. And then a shorter, but still very detailed version of what these changes mean for graduate students. This may apply to you, or it may apply to your students either this year or in future years, and having a much better understanding for how federal loan support for graduate students has changed is going to set you up better for planning ahead to which schools you may want to attend and which program types might be actually ones that you can attend. I'll leave you with 2 or 3 minutes on changes to the repayment plans that go into effect in July for federal loans, and just another 2 minutes on what Juno's role is in helping people who are going to face some challenges as a result of these federal loan changes. If you have any questions as we go along, please do feel free to use the chat box to ask those questions. I'll look at the box every couple of minutes and make sure that I'm answering things that are relevant. And I'll make sure that you'll get a copy, or I think at some point this week, you'll get a copy of the materials that we're going over in a recording. So one last housekeeping note before I really dive in. The way that the changes came about is what Debbie stated. Last July, there was a bill passed into law, and that bill had specific things that we're going to talk about tonight that impact the amount that parents are allowed to borrow, the way that you can repay those loans, and it unfortunately didn't spell out every single bit of how those changes would impact students for the upcoming year. But there's an ongoing negotiation that the Department of Education is doing to determine how a lot of edge cases in implementing that bill actually work. What I'm going to present to you tonight is the most recent version of what we expect the answers to those edge cases to be. Some of these things could theoretically change over the course of the next 3 months as those negotiations finalize. And once we do have a completely final set of changes, if there are any things that change from what I'm presenting to you tonight, I'm happy to send those over to Debbie, and we can make sure that people find out what the final version of the changes are too. So let's just start off with the first and perhaps the most important concept here, which is high level. There's big changes that impact any student who is new to college starting July 1st of 2026 and beyond. But for anybody whose student may have already been enrolled in college prior to July 1st of this year, and who meets a few other criteria that we'll talk through on the next slide, you may be eligible to avoid any of the changes we're going to talk about tonight. I'm going to refer to that as grandfathering. Some people are going to refer to that as legacy status. What you need to know is the legacy version of these federal loan programs is, generally speaking, better for most people than the new versions that were passed into law. And in some cases, you will have the opportunity to keep those legacy provisions that will allow you to get significantly more funding than what the new provisions will allow. The 3 things that we'll talk through tonight in a lot more detail are: 1, a lot of parents end up borrowing something called a Parent Plus loan from the federal government to help pay for their students' undergrad. And the amount that someone is allowed to borrow through that program on a go-forward basis is a lot lower than what it has been historically. 2nd, graduate students historically have been able to borrow whatever amount they've needed in order to meet their tuition bill. And starting this July, new graduate students are going to face, again, significantly lower amounts that they're allowed to borrow. But it's going to be different depending on what degree they're studying. And we'll go into that in a lot of detail. And then we'll cover what the changes are to some of the repayment plans, which in some respects are more generous than the ones that have existed historically. Uh, and so let's just start off with a little bit more commentary on how legacy works. This grandfathering provision that says if you've been enrolled in college before July 1st of 2026, you might be able to keep the old rules. So first off, I basically covered this slide over the last minute, but what grandfathering really does is it's classified in the text that's written as an exception. It basically just says that you are not going to have any of the new rules apply to you for a period of time. It's not an unlimited period of time. We'll go through that in a second. But for a period of time, if you'd already been enrolled and you'd already taken out a loan from the federal government, then you'd be able to avoid the new rules. And this is a really quick rundown of the four things that you want to pay attention to that would allow you to stay grandfathered into the old rules. One, you would have to have been enrolled in a program at a school by June 30th of this year. Two, you would have to have already borrowed a federal student loan by that same date. And by borrowed, it means they use a specific term called dispersed. And what that really means is that you had both borrowed a federal student loan and the money had already been sent to the school. And so what that really is trying to do, that whole provision, is say, let's make sure that we are taking the people who had already borrowed federal money and relied on an expectation that they'd be able to keep borrowing a similar amount of money and just freeze things in place for them so that we're not pulling the rug out from under them. Unfortunately, that doesn't apply to new students, but that's what this is intended to do. The third requirement is pretty important. We're going to go through a few examples of this later on, but you would need to stay enrolled in the same program at the same institution. And so what that really means is if you are, let's say that you met the first two prongs of these requirements, and you were studying at UCLA last year, but now you transferred to a new school for the fall of 2026. Unfortunately, you break that legacy protection. You would no longer be grandfathered into the old rules because you transferred to a new institution. And the fourth requirement is that you don't withdraw from the program. I'm going to go through that in a little bit more detail in about 10 minutes. And specifically what that means for parents and for the Parent Plus loan. But if you meet these four provisions, then generally speaking, you would have the legacy status. If you break any one of these four provisions, then you would lose that legacy status.
Chris, there's a good question somebody has
Yes.
about what if they do a semester abroad and they currently have, Parent Plus loan.
That is a very good question. I was researching the same exact question because I was asked it this morning. I don't have a perfect answer on that yet.
And somebody's
I'll
also
show
asking,
you.
what if they do a co-op? So it's basically, they're still connected and in theory enrolled in the college, but they're taking these breaks.
So it's a really good question. This is one of the slightly weird edge cases that we're hoping actually gets clarified in the next 2 months. And the reason why is I'll just give the quick summary of it now and we'll go into it more detail later. If the school, the way this all works is if the school basically tags you as withdrawn, you lose legacy status. If the school tags you as taking a leave of absence that falls under certain rules, then you don't lose legacy status. And I don't know, and there's not really a strong answer yet on exactly how a school would treat someone who is doing a co-op or who's doing a study abroad program, whether they would still be considered as not withdrawn for that term or not. Uh, and the reason why this is actually a little bit more confusing even is because this is not an issue that schools have had to standardize and have had to ever focus on trying to code into their systems in any specific way. Part of the discussions that are going on right now around the negotiations for how to implement these rules is around issues like this. To the best of my knowledge, these specific questions I haven't seen asked in the transcripts that I read from the negotiation committees, but it might be in there and I'll double check. Very good question, though. There's another pretty important concept here, which is whether you can, how long you're able to actually keep these grandfathered legacy loan limits. And the specific way that this gets implemented is by saying that it's going to be the shorter of either 3 more academic years or your expected time to completion for the degree. And so I'm going to just give you 2 examples that are going to do a better job at presenting what this looks like than going through the official text that's been published. So let's just take one example where somebody is studying at a 2-year master's program. They started in the fall of 2025. When it gets to June 30th, which is the date that we're talking about all these things for, they've completed one of those 2 years. They have one more expected year to credential at that point. And so they're actually only allowed to keep using the legacy version of graduate loans for this person for 1 more year. If they ended up taking longer than 2 years to complete the degree, they are out of luck. And the reason why is the way that this rule has ended up getting settled is by saying that they're going to define the length of the program specifically as whatever gets marketed in official publications or catalogs or marketing that the school provides. And so if the school is on any of their marketing materials saying that it's a 2-year program, but some people end up taking 3 years to finish it, then 2 is going to be the number that gets used here. Maybe a slightly different example that might showcase the change is that a lot of PhD programs are very long. And if you, let's say, are in a 5-year PhD program, you still only have 3 more years of eligibility under this grandfathering provision, no matter what. That's the absolute maximum that you can get. And so you might have started your PhD last year. For the next 3 years, you could continue under the legacy provisions, but in year 5, you would not. You would face the new limits that we're going to talk about. So for parents of undergraduate students who may already be enrolled and may be actually eligible for this legacy status, the really careful thing to budget for and to think about that it's not going to impact you this year for the most part, but in future years, just be really careful. If your student ends up doing a 5th year or going longer than the expected time to credential, then you are unfortunately going to hit the new loan limits that we're going to talk about in the next couple of slides.
That's a good point, Chris. I hadn't really thought about for the situations where the student, ends up in a 5th year, which, it happens more than most families would like. So you're saying that 5th year, they are going to have to deal with the new regulations, even though they might have had a Parent Plus loan for the first 4 years.
Correct. Unless that was marketed as a 5-year program, which some are, in which case they may have 1 more year of eligibility. But no matter what, starting from this July 1st and on, there's 3 more maximum years of eligibility that's left. There's a good question here that, let me just touch on this before we get into the rest of these Parent Plus changes. And so the question is, my child has received a direct unsubsidized loan this year, but not a Parent Plus loan. Is he grandfathered for all available federal loans? And per the most recent guidance, yes. As long as you've taken out any federal direct loan, whether that was what the student took out in their own name or what the parent took out as Parent Plus. Both of those count for your grandfathering eligibility, as long as you meet the other requirements that we spoke about on the last couple of slides. That was a gray area that we didn't have full certainty around over the last couple of months, but based on the most recent notes from the committee, there was unanimous consent. Everybody who had to vote on whether this is how we're going to implement it or not agreed that this is how we're going to implement it. So now we're going to talk just more about how these impacts or how these changes are going to impact new students. And so I really wanted to just set the stage for how these grandfathering rules work, because it's going to apply to maybe 10 or 20% of folks. But now that we're going to flip into what happens to Parent Plus loans that a lot of people end up using to help pay for undergrad. And I want to just set the stage with helping you understand one core concept, and then we'll move on. And so I always like to start this part of the conversation by talking about cost of attendance, which is really the sticker price of going to school for the upcoming year. What you see on the slide in front of you is just an example of what it costs for a student living off campus, but who has in-state status to attend UCLA for the past year. And so it's a combination of their tuition and their fees and allowances for living expenses, books, and transportation. And altogether, that number totals $43,219. Now, the reason that this is important is this is the maximum amount under current rules that the federal government is allowed to, that a school is allowed to let you borrow across all different loan types, whether that is a loan the student can take out by themselves or a Parent Plus loan or a private loan. In aggregate, those cannot exceed that $43,219 number for a UCLA student, for example. That number will change from one school to the next. In reality, what you're allowed to borrow is actually limited by what that $43,000 number is, minus any other aid that you have received from the school or other sources. And so what I want to communicate on this slide is really just how things would work for people this past year who didn't have a lot of savings to pay towards school and needed to borrow a lot of money from the federal government. What would have happened in this example is you started with that $43,000 cost. And let's assume that you got $5,000 of scholarships, and then that you had $5,000 of savings to help pay towards school. That would leave you with $33,200 that you still had to find some way to pay to the school to meet your tuition bill for the full year. What you likely would have done in that scenario is that first, more likely than not, the student would have borrowed something called a direct loan, which is a loan that they can get from the federal government in their own name. I'm not going to go into a lot of detail about how that loan works tonight, but over the next few months, as we've done for a few years now, we'll go through a much deeper dive on how every single federal loan product works and the rates and terms and things that you should know about them. What we should know is a first-year student, it can borrow $5,500 if they are considered dependent. And that is not changing. So in all of the rules and all of the legal adjustments that have been made, the $5,500 number stays the same. Most first-year students will be able to borrow that amount to pay towards school. And in this example, after the student had borrowed that maximum amount, there would still be roughly $28,000 left that the parents would have to find some way to pay to the school. And traditionally, they could have borrowed the entirety of that through the Parent Plus loan program, which is simply another loan from the federal government. You do have to apply for it. That's not changing, but there's not a minimum credit score cutoff. There are a few specific reasons why you could be denied access to it, but it doesn't work like most private lending products do. They don't take your credit score or income into consideration. You would just, as long as you meet the basic qualifications, be allowed to borrow that full $27,719 number. Now, this is the first of two very big changes that are getting implemented starting July 1st for everybody who has a student who's starting in college for the first time. And that will impact everybody who is the parent of a junior or a sophomore whose children are going to school in the future. Starting now, really starting July 1st, you're going to be limited to borrowing $20,000 per year through the Parent Plus loan program. Doesn't matter what the school costs. This is the annual cap. This is an annual cap per student and not per parent. So what that means is if both parents wanted to use a Parent Plus loan to help this one child meet their tuition bill for the year, the aggregate amount that they'd be allowed to borrow would still be limited to $20,000. That might be the most common question I've gotten so far is, can each parent borrow $20,000 towards the student school? The answer is no. It's $20,000 per student per year. That's the first limit to understand. The second thing that's going to impact you is the lifetime cap. And this is actually a little bit more important to understand if you're trying to plan ahead for how to pay for all 4 years of college. So parents of new college students are going to be limited to this 65K across all 4 years of borrowing. And the really implication of this is you're going to be limited to $20,000 per year in each of the first 3 years of school, and then only $5,000 in the final year. And so this might have even more of an impact on your choice of which school to attend based on its current overall costs, to make sure that you're making a sound decision, and that even if the $20,000 that's available to you today might cover what the tuition bill looks like, just know that in that fourth year, there's going to be this shortfall and only $5,000 more available if you've already maxed out the entirety of what you were eligible for. Now, a few important things to caveat about this. If this is a per child cap. And so if you have 2 children, there's a separate $65,000 cap for each one of them. If you repay, let's say Parent Plus loans that you've borrowed early, it actually doesn't reset the cap. And so just be careful in situations where you think, oh, maybe I didn't need this and now I want to repay this Parent Plus loan early. If you then end up in a situation 2 years from now or 3 years from now, where maybe you do actually need more Parent Plus dollars, your cap doesn't reset. You've already used a portion of that 65K and you can't get it back. There are some cases where funds just get returned. And I won't go into that in a lot of detail until we get to Q&A if we have questions about it. But there are certain rules around returning funds that don't count as repaying funds. Just be aware of this. And that cap applies across all institutions and all years of borrowing for that student. There are some open questions that I'll try to get to at the end that are not settled yet in the rulemaking that's happening. But this is maybe one of the more important things to just walk through a really quick example for. And so I'll just spend 1 minute going through a view of what would happen for the theoretical family that needed to borrow Parent Plus loans for somebody attending UCLA over the next 4 years. And let's assume that this is somebody who does not have legacy status, somebody who is not grandfathered into the old rules. What I'm showing you here is just the table version of the slide that I showed you a few minutes ago. And so we start with that $43,000 cost. We assume that after $10,000 of scholarships and savings that were available to pay for school, we still have $33,000 left to borrow. The student borrows $5,500. The parent borrows $20,000. And that actually now leaves them with $7,700 of unmet need. These are dollars that you can no longer in any possible way get through the federal government for this example family. And your only choice would be to either find some way to get more scholarships, to potentially get some other forms of aid from the school if they have it for you, or to explore what your private loan options would look like. And that just gets quite a bit more stark as you play out that same example to all 4 years of potential borrowing for this example family. What you really just see on the right hand column is that by the time you get to year four, you have roughly $21,000 shortfall in that year. And that $21,000 shortfall is more likely than not going to have to come from some other loan source that is not going to be the federal government. And across all 4 years of borrowing for this example family, they would need a little bit over $40,000 in private loans if they had not already found another way to pay for this. And so I'll just call out one thing before I switch to maybe taking a quick look at some of the questions around this. And this is unfortunately not a cost of attendance for an expensive school. It feels shocking to say that, but $43,000 a year for cost of attendance, it's very expensive, but a lot of schools are significantly more expensive than this nowadays. And historically, parents have been able to rely upon the Parent Plus loan in most cases as an escape valve that would allow them to meet the entirety of the unmet need they had for the upcoming year. And now that that is no longer true, then people have to be very proactive about making sure that they will find a way to actually meet the full cost of attendance for each year. And because it is early enough for most people to be thinking through this in the middle of January, I would really just stress that the selection of the schools that you decide to attend is more important for this reason for the upcoming year in the future than perhaps it even has been in the past. It's always been incredibly important, but we might move from a scenario where the worst case was that you borrowed too much to not actually being able to meet the bill at the end of the day. All right, let me make sure to try to answer a handful of questions here because I see those popping up. Here's a question on, is the $65,000 limit for 4 years of undergrad, does it reset to borrow another $65,000 for grad school for the same child? It's a good question. This is the 65K limit is only for undergrad. Parents cannot use federal loans to borrow money for graduate students. What we'll talk about 5 minutes from now is actually a deeper dive on exactly how graduate student lending works and what the options are that are available to graduate students specifically. And I'd say it's equally important to understand that for anybody whose kids might even remotely be thinking about graduate school in the future, because there are significant impacts depending on the degree that you're choosing to study.
So, Chris, I've been answering questions in the chat, and a few questions that have come up are related to families that might have multiple students in college at the same time. And they're just kind of confirming the $20,000 a year, the 65,000 lifetime cap, that's per student. So if you have multiple children in college at the same time,
Yes,
there's not necessarily like a family cap where, on how many students you can borrow for.
exactly. So both the annual cap and the lifetime cap are per student. So that they will multiply by the number of students that you actually have in college at the same time or at any point in time. And so just be aware of that. But
Um,
they don't multiply by the number of parents you want to borrow.
right,
And
right.
I know that I've mentioned, I just want to make sure that we stress that. It's not a situation where if you have one student uh, and two parents who are willing to borrow a Parent Plus loan, each parent cannot borrow 20K. They could each borrow 10K so that they meet the 20K cap, but that's still going to be the 20K cap that governs what the student is eligible for.
So somebody is asking, just again to kind of reiterate and confirm, does the $65,000 cap include any of the borrowing that the student is allowed to do? Like, the from the,
No,
the student federal loans.
very good question. No, it does not. Uh, Now, when we get to the grad students, it's a slightly different, more nuanced answer. But no, when it comes to Parent Plus, the only thing that is viewed is the borrowing that the parent has done through the federal government on the student's behalf.
And somebody is just asking, and I don't know if Chris, if you have this in your slides, but maybe just give people an idea of what the interest rates are. And I know
Yeah,
in future webinars we go into detail about how it's set, but just to give people a general idea of like what they are currently and that they will change.
yeah. So currently, there's the Parent Plus loan that we're talking about is 8.94% interest rate. Uh, and that comes with a roughly 4% origination fee. Uh, and the formula, so at roughly the middle of May of each year, there's a new rate that gets calculated for all new Parent Plus loans that are taken out for the next 12 months. So the general way to just think about this, if anybody, if I'm speaking Greek, I apologize, but all the formula really says is we look at what the cost of borrowing for the US government is for a 10-year bond. And so you look up just the 10-year treasury rate, and then it adds 4.6% to that number at some point in the middle of May. And then that locks the new Parent Plus rate that's going to exist for parents who need to borrow for the next academic year. Uh, if you borrowed, but just to be clear, let's say this year you borrowed a Parent Plus loan. It had an 8.94% rate. That's a fixed rate. That's not going to change until you pay it off. But the next Parent Plus loan that you take out might have a slightly different rate based on changes that have happened in the market and how that rate got set. On Parent Plus loans, interest is not deferred until 6 months after graduation, but you can defer having to make payments until 6 months after graduation if you choose to. I'm going to just walk through three really quick examples of things I just want to stress that for anybody who may be eligible for legacy status to watch out for. Number one, I get this question a lot. Can you change majors and keep legacy status? And the answer is yes for undergrad. So as long as you're staying at the same school in the same degree type, you can change majors just fine without impacting your legacy status. The committee that was negotiating these rules realized that they had to keep it this way because a lot of people are undeclared and majors change frequently. More importantly, be very careful about transferring to a new college because that will break legacy status. So I gave you an example earlier of somebody who was attending one school last year and who was eligible for borrowing more Parent Plus loans under the legacy rules, transfer to a new school for the fall of 2026. And unfortunately, under that example, the legacy status does not carry over. So changing majors is okay. Changing schools for the purpose of preserving this is not. And this is where I touched on this briefly a few minutes ago, but withdrawals are treated differently than an official leave of absence. This is the text-heavy slide. You will get a copy of this still. And the short version of the answer here is you lose this legacy eligibility if the school officially marks you as having withdrawn. You keep the legacy status if the school marks you as taking an official leave of absence. And the gray area here is that schools don't yet have and have not historically had a uniform way of communicating or logging what is a withdrawal versus a leave of absence. The purpose of the tagging the leave of absence is, in the way that these rules are set up, is a leave of absence says that you actually do intend to come back to the same program of study and to continue and pick up your studies where you left off. And under that situation, you can keep legacy status. But if it's tagged as an official withdrawal, then you would lose it. And I know that there are open questions that I don't think anybody has an answer to right now about some of the edge cases around what things that could theoretically be classified as a withdrawal by the school. Uh, but I'm keeping very close attention on what the updates are on those changes, and we'll make sure to try to communicate them once we have them.
Chris, there's a good question that somebody's asking about, can relatives other than the parent take out a Parent Plus loan? And if another relative wants to help borrow to help the student, how can they do that?
So, to the best of my knowledge, unfortunately, the answer is no. A Parent Plus loan is not able to be taken out by a relative or a grandparent or somebody else.
Unless
The
unless
only
they unless the parents have passed away, right? And that relative happens to be the guardian.
legal guardian,
Yes.
yes. There's one other exception where if the parents are alive, they applied to a Parent Plus loan,
Yeah.
but they were rejected for that Parent Plus loan, then another person is allowed to co-sign for that Parent Plus loan. The language that the Department of Education uses, if you want to Google this and learn more about it, is endorse. So you can have an endorser for a Parent Plus loan that is not the parent, but only if the parent themselves has actually been rejected for that Parent Plus loan. I just wanted to leave you with a brief checklist on just summarizing the things that we spoke about, the key changes to Parent Plus loans actually are. And so I won't go through this again in a lot of detail just for the sake of time. But the reality is that for anybody who's not going to have this legacy status or this grandfathering provision, which is effectively everybody whose students are starting school from July 1st and on, that these new loan caps exist and that there is not any way to get around them. And if you do hit these caps, you still need to get funding. I would really recommend one of three things. First, and I think I see that Debbie already shared this, you do really want to more aggressively pursue scholarships that can help you reduce the amount of unmet need that's left after the maximum amount of federal loans that you're able to take. Second is that because we're early on enough now, we can talk about this, you may want to more aggressively appeal the results of your financial aid offer. Because there may be certain things that you can do that can help you get some more forms of aid that could reduce the amount of unmet need. And third is just to be aware that if you don't have other savings or that are going to be used to pay for school for the upcoming year, that you may have to explore what private loan options look like. Do not trust me or anybody when they say that they have the best product for you, but do shop around. If there's only one thing that I could stress, it's that I think there actually will be a lot of solutions that are available to people. Almost everybody who uses Juno to pay for school uses it because they're qualifying for rates that are lower than what they get through Parent Plus with no origination fees. And so our process has worked for 7 years. If you give us a chance to see if we can provide you with a better outcome than you might get by yourself, that would be greatly appreciated. And for anybody for whom this is not relevant, I apologize, but I do think getting a better understanding for how all of these changes are going to impact graduate students is quite important, especially because there's things that you can plan multiple years in advance, especially if your children are considering grad school in any way. Let me start off with, again, just a little bit of context setting on how graduate students would pay for college this year. And so historically, graduate students have two options to pay for school. The first option says you can borrow up to a certain amount of money at a slightly lower rate, but there's a cap, and that's called direct unsubsidized. The second option, which a lot of grad students end up using, is called Grad Plus. So that lets somebody borrow really all the way up to whatever that cost of attendance number is, minus the other forms of aid that they've been received, that they have received. And so, what a lot of grad students would do is, let's just say that you're going to law school this year. You would borrow the first $20,500 from the federal government through that first loan program because it has a lower rate and a lower origination fee. And you'd borrow the remainder of what you need from Grad Plus. Now, what's changing, starting for anybody who's a new student in the July and on, is that there is no more Grad Plus. There's no more Grad Plus, but there's slightly increased amounts that some students can borrow from the first of those two loan programs. And so let me give you a little bit more color into what that looks like. But most importantly, let me start with this concept of a professional degree. The way the law was written that governs the changes that are made to the Grad Plus program is to say there are certain degree types that are allowed to borrow more money each year under the new rules that will go forward, and certain degree types that we're not going to allow to borrow more than $20,500 per year. And what I'm showing you on the right-hand side is currently what has been settled on as the specific degree types that the Department of Education classifies as professional under this definition. And everything that doesn't fall under these specific degree types, generally speaking, is going to be considered a graduate degree, and they'll be allowed to borrow less money each year through the new programs. This is not a judgment on what careers are professional versus not. It's really just an arbitrary term that was used in this process to decide what degree types are we going to allow to borrow a lot more money than other degree types. There are a lot of notable exceptions for degree types that are, there's controversy, candidly, around degree types that have been left out of this professional designation. There are a lot of PhDs or MBAs or doctors of physical therapy, even doctors in nursing and some other things. They don't meet the professional threshold that's been set up by the law and by this negotiation. I'm going to go through in the next slides what that actually means for your people's ability to get federal funding to complete those degrees. But this is one of the most important things to actually understand. It's that there is going to be a huge difference in people's ability to access graduate school based on what degree they're studying. And this is what the difference itself actually looks like. So if the degree that you're studying is determined to be graduate, then you can borrow $20,500 per year. If it's considered professional, then you can borrow $50,000 per year through the federal government. And there's another aggregate limit on top of that, similar to how we spoke about the Parent Plus $65,000 aggregate limit. So it doesn't matter how many years you're in graduate school and going into a graduate degree, you're going to be capped at $100,000 lifetime. And similar logic applies to professional students. It doesn't matter how long the program is or how many different grad schools you go to, you're going to be capped at $200,000 of lifetime borrowing through the federal version of these programs. And so what I wanted to do is try to visualize what impact this would actually have first on those professional degrees, because sometimes people will hear the $50,000 number and think that that's actually going to be enough for what people need to attend medical school or law school or a range of different degree types. And the unfortunate reality is that even with the higher of those two loan limits, if you just look at the average cost of attendance last year for all of the schools that cover each of the degree types you see on this slide, the $50,000 loan limit for professional students is still too low. The hope is that over time, schools will be able to bring down their costs somewhat, or that people will start attending schools that are already cheaper and that those will increase in enrollment over time. But this is something that is critically important to be aware of if you or your children are entering graduate school this year or at any point in the future. The funding gaps for dentists, for doctors, and for a lot of different degree types are going to be rather large. And that $50,000 number is not going to grow over time. Uh, it's going to stay flat. And from what we've seen over the last 30 years, the cost of tuition and cost of attendance has only continued to rise. And I would expect those gaps to potentially get even larger over time.
So, Chris,
Uh,
do you know, like in the past, before these, caps were even talked about, students attending, let's say, dentistry or or medical school, what percentage of students actually took out their loans through Grad Plus versus private loans?
Great question. So the data doesn't exist to say what percentage took out Grad Plus versus private loans because the private loan data doesn't it's just not available publicly to folks. But from what I can tell you is just commentary from talking to a lot of financial aid offices, as well as the data that is available. If you look at dentistry or medical degrees or law, for example, what you'd see is that on average, somewhere between 60 and 80% of students, I think that's the 25th to 75th percentile of, like, if you look at an individual school, typically 60 to 80% of students are borrowing uh, federal dollars to pay for that school. And more often than not, some of that is not, most of that borrowing is actually Grad Plus borrowing. Um, and I can tell you candidly, when the degrees that are on this slide right now, almost all of the borrowing that has happened at those degrees has historically been uh, federal borrowing, because a lot of people who attend these degree types may end up working in the public sector or some not-for-profit setting, including a hospital system or being a prosecutor, and that could theoretically enable them to have their loans forgiven after 10 years of service. They don't know for sure what they're going to do when they graduate. So a lot of people gravitated to opting into using the federal loan programs.
Hmm.
I'm just going to cover two key things to understand that will further impact graduate students, and then move on to just a really quick overview on how the new repayment plans may impact people, which is a slightly brighter story. So if you're enrolled less than full time, as then the amount that you're allowed to borrow for the upcoming year actually gets reduced. And there's still a little bit of negotiation happening on the edges around this. But let's say you were attending a nursing program at USC, and that nursing program had a cost of attendance. I'm just going to make it up for simplicity and say $20,000. If you're actually attending it as a half-time student for the upcoming year, then your borrowing limit as a student is actually reduced to $10,000 for that year through all of the different federal programs that could be available to you. And so just kind of be aware that if anybody is trying to budget and plan ahead, and we have a different presentation that goes into a lot more detail around this than I can really go into right now. But it impacts your borrowing limit. This also, and I didn't touch on this on the undergraduate side, but I mentioned that there's two loans that that a family can borrow from the federal government to help pay for undergrad. The first one is the direct loan, that's that $5,500 number. And the second one is the Parent Plus. This concept that I'm showing you here also applies, but only to the $5,500 portion of what a first year student can borrow. So if it's a first year student who's going to school and they happen to be enrolled half time, then they can actually only borrow $2,750 for the upcoming year. But that adjustment, actually, it's not going to apply to the Parent Plus limit on what you're able to borrow. And so it has no impact whatsoever on that. And the last thing that, and I might be getting into a little bit too much of an edge case here, but a lot of people are dual degree students in grad school. And sometimes those dual degrees are a mix of one program that's considered graduate and another program that is considered professional. And the way that the current rules are expected to go through says that the student is going to be treated as professional for the amount they can borrow for the year, meaning they can borrow 50K, as long as more than 50% of the credit hours count towards the completion of the professional degree. And so if you're in an MD, MPP, or that's a lot of different combinations of these types of programs. This is not totally finalized yet, but at least in most cases, the professional limit is likely to be the thing that applies. And same thing as what I showed you at the end of the undergrad section. Just like a relatively short cheat sheet on things that you might want to know, the key takeaways from what we just spoke about that pertain to graduate students. So again, I won't go through this right now, but it'll be helpful if anybody wants to refer back to it when you get a copy of the materials. All right, there's new repayment plans. I could spend an hour on this. I will not, but you're going to hear a lot more about this. There's a lot more nuances that will impact potentially Parent Plus borrowers I won't be getting into right now, but that we will over the next few months. The most important thing to understand is that for the starting July 1st of this year and on, there's two new plans that will govern how you actually pay back these loans. The first one is it's similar to what already exists with a little bit of a modification. The standard repayment plan, it in some ways kind of works like a mortgage. It would say, this is the number of years that you are going to pay this loan off. And we're going to have the same monthly payment every month. And at the end of this number of years, you're going to be done paying it off. It's a little bit more nuanced because you're allowed to defer making any payments until 6 months after graduation. But from that point, 6 months after graduation and on, you're going to have X number of years to make equal payments that pay off this loan. And the change that has been made to that program is to say that the number of years, the term length, is actually going to be a sliding scale. It's going to adjust based on the initial balance that you have. And the way to look at it is what you kind of see on the bottom left part of the slide. If you have a smaller loan balance of under $25,000, then you have 10 years to pay it off. But if you have in aggregate a larger loan balance of $100,000 or more, then you have a 25-year window to pay it off. This is a very big and very important adjustment because historically, 10 years was the standard for everybody, regardless of how much their balance was. And for a lot of people, that became far less affordable. And what's I'd say even better about this is you're traditionally, for anybody who's, let's say, shopped around for a mortgage, a 15-year mortgage has a lower rate typically than a 30-year mortgage. In this case, that's not true. Your rate's going to stay the same. There's going to be no change that's made, even if you have a significantly longer amount of time to pay off that money. The second thing is called the repayment assistance plan. And this is really, you can think of this as a slightly less generous version of the SAVE plan that you may have heard about over the last couple of years. The bottom line is that this is a plan that is meant to, I think a lot of people are going to end up using. And what it does is say that we're going to, no matter what your loan balance is, we're going to set the monthly payment to the formulas that you see on the bottom right-hand side of the slide. In fact, let me just switch to this version of the repayment assistance plan. This is really, it's not going to be available for the Parent Plus loans. Parent Plus, you'll be using that standard repayment plan. But for the money that the student borrows, whether for undergrad or for grad school, they are going to have access to this repayment assistance plan. Is going to set that monthly payment to a percentage of their adjusted gross income. And it has a lot of key features to it that, in effect, basically say uh, as long as you're making whatever the required payment is on a monthly basis, we're not going to let your interest on the loan continue ballooning out of control. We're going to effectively freeze that in place. And so you will always make progress every single month towards paying down that loan, which is very different to how a lot of the federal loan programs have historically worked, except for a handful of cases. And so uh, I'd say that the key takeaway to things around the repayment plan scenario is that unfortunately, while people are able to borrow less through these different federal loan programs, the uh, options for repaying these programs are going to be a little bit better than at least what they are today. And I'll just end with this before we turn it back over for Q&A if folks do have time. And that's really the key way to prepare for these federal loan caps is to be aware that you may need to ultimately use a private loan and to shop around. Uh, I gave you my spiel earlier about how and why we started Juno. I was, in fact, and perhaps unfortunately, one of my own biggest customers. But the process that we've run for the last couple of years has worked phenomenally well. And the way it ultimately works is uh, I'm spending a lot of my time all around the year trying to talk to different lenders in the marketplace about what we're doing, about the number of people who are signed up on Juno who express interest in potentially using the product over the course of the summer. And the larger that group is, the more leverage I have in those conversations to try to ask those lenders to give something special and do something better for that group. You can kind of think of it in the same way that Costco has an enormous amount of negotiating leverage with its suppliers because it can say we're bringing a huge number of customers to the table. And Costco's customers don't have to buy anything. But when they are shopping around for something, they'll at least check to see if there's a cheaper version of it available there. And that is what we have built here for the last 7 years, specifically for student loans. I saw this question a handful of times that I want to answer honestly, which is what's in it for Juno? Juno gets paid when somebody actually uses the loans that we've negotiated to pay for school for the upcoming year. But I don't want anybody to actually use that unless one, they have to get a loan, and two, if it's actually the cheapest version of a loan that they have access to. And so I'm hoping that that aligns incentives enough for folks to at least consider shopping around and giving us a chance to check to win your business at the end. And I'll make 4 quick promises to you right now. The first is that there is no cost to sign up to or to use Juno for you. It's just a free option. You just enter your contact information, graduation year, and it's optional to enter any other information. We don't share your information with anybody. And we really just use it to be able to tell you would be every 2 weeks for the next 2 months, an update on where we stand on our negotiations. And on June 1st, an email that tells you how you can check your rates without impacting your credit to at least get some sense for what the best thing is that we've been able to bring to the table. We always try to set things up so that whatever bank or lender we partner with, there is a process where you don't have to do a hard credit check to at least see what rates you might be eligible for. So it takes you 2 minutes to check your rates when we send that final email in June. And we're only going to work with lenders in our marketplace that are not going to charge you application fees, no origination fees, and no prepayment penalties. And all of the options or of the lenders will at least have one option where you are not required to make payments in school. Finally, and perhaps most importantly, we spend the entire year talking to thousands of different parents one-on-one about different issues around financial aid. We do that for free. There are a lot of places that will charge for that. We do that over email, phone, Zoom. If you need help with negotiating a financial aid award, if you need somebody to just weigh in on any decision that you're trying to make, or at least help you guide you towards resources that could be helpful in answering a question, Our team does this all day, every day, all year round. And so please do feel free to use those resources, regardless of whether you ultimately end up using us in any way to pay for school. That doesn't matter. But if you do use our resources and have feedback on how we can make it better, that's the most valuable thing I could get out of it. All right, let me turn over to the Q&A and see what we've got. So let me, I'm just going to start going down the list on the webinar chat really quick. Uh, so there's a good question here on somebody has a current high school senior. That senior is not going to be enrolled in college before July 1st. Uh, does that mean that they are not eligible for the legacy status? And unfortunately, the answer to that is that yes, they are not eligible for the legacy status. In order to be eligible for that legacy status, the student would have to have already been enrolled before July 1st and have had a loan that was dispersed to the school. And so I'll often get the question about an edge case of, well, can I somehow get enrolled before July 1st and make it official, even though my term doesn't start until the fall? Unfortunately, no. There really is no way around that because you would also have to have uh, applied for a Parent Plus loan and had it sent to the school and had the school accept it before July 1st. And while there may be a few edge cases where a school might try to figure out a way to make that happen, it is not something that I see schools able to do or trying to do right now.
Chris, there were a few questions about whether Parent Plus loans are eligible for PLSF, can somehow the Parent Plus loan eventually be consolidated or moved so that the student can pay it off?
It's a good question. And that's part of what I said. I think there's more like an hour-long conversation around the edge cases. So uh, short answer is if you have a Parent Plus loan, more likely than not, you're not going to qualify for the PSLF protections that the student is able to get. There are exceptions to that. There are scenarios where you can, but it's not remotely the same. Some of the complications that are going to arise for Parent Plus borrowers are especially in cases where you have a legacy borrower who borrowed a Parent Plus loan last year and is going to borrow a new Parent Plus loan. If they borrow any new Parent Plus loans from July 1st and on, they are actually automatically going to be limited to using that new standard repayment plan that I showed you on the slide, which might not sound so bad, but there's actually a couple of different things a few very specific things that you may lose access to that you'd currently have. There's a flow chart and a bit more complication, and not every rule around this is currently settled yet. And so I don't want to lead people down the wrong way of thinking for this, but I will. I think it might be worth touching on that at some point in the future with the materials that we've been presenting to other folks. Yeah. Sorry, there was a second question there.
Sorry, I can't remember. Can somehow the Parent Plus loan be transferred so that a student can pay it off?
So the most common way that that's going to happen is through a process called refinancing. And so, and that's not a universal comment. Not every scenario lender would let you do that, but you can, in some cases, really a lot of cases now, refinance that loan after the student graduates, as long as the student themselves is considered sufficiently creditworthy and meets whatever the debt to income ratio requirements are for the lender that's letting you do that. And so to make that a little bit more simple, uh, if you have $65,000 of Parent Plus loans that are outstanding in 4 years, uh, and the student has $35,000 worth of loans that they've taken out in their own name, then there are cases where they may be able to refinance all $100,000 of existing loans under their own name, but they will have to have a job and pay stubs, and they will be checked to make sure that the monthly payment that they're going to be obligated to make when they do refinance is going to effectively be affordable enough that they'll be able to make it work, and they'll have to have whatever the minimum credit requirement is for the lenders at that point in time.
So, Chris, is a good, I would call it philosophical question about do you think colleges will adjust to these new, more federal funding limiting rules? And do you expect that they might give more institutional help or will they take significantly more full pay students? So, basically, the question is how do you think colleges are reacting to these limits?
Really good question. You see on the undergraduate side so far, and also on the graduate side, kind of two tiers of reactions. There's some schools that have that kind of know they don't have to change their pricing at all. They'll still get people to fill these seats, and they're kind of waiting to see if they're going to have an issue. And they're not changing very much of what they do. Like within that bucket, some of them have a lot of aid that they're able to give, and hopefully they'll be able to give more. But I wouldn't count on that. There's a lot of other schools that kind of fill in that bucket of they're super selective. People are still going to enroll. Someone's going to find a way to pay, but they don't have a lot of money that they're able to give to people. And so I think, unfortunately, at some of those schools, you're just going to see more people end up accepting that offer of admission who are able to pay for it. And then there's what seems to be so far a larger list of schools that are more worried about whether they can actually fill these seats. And there's kind of an ongoing that I see this at quite a few different schools, just an ongoing discussion about can we actually bring costs down a little bit, and how long will it take us to be able to do that over time, or can we get closer to at least freezing costs in place so that more people are able to attend. One example is there's a law school that more recently reduced its tuition, at least from $66,000 to $50,000, which just so happens to be the maximum amount that a grad student can take out to at least pay for tuition for the upcoming year. It's not enough to cover their living expenses, but they did it. And it was the first one that I'd actually seen done. My 2 cents, I would bet that this is effective, that schools do bring down their costs somewhat over time. But I don't think that they'll be able to do it quickly enough and at the same time, even if they're able to freeze those costs in place, the unfortunate reality is that the loan limits that were written into this bill are not indexed to inflation. And so those loan limits are not going to go up over time. Even if schools just kept their costs flat, it would mean that they're still cutting things here and there. And it'll be really hard to make whatever the gap looks like today much smaller.
Maybe just to reiterate, somebody's asking, will students still be eligible to take out direct loans, and are there no caps on how much they can borrow for undergrad?
Students are still eligible to take out direct loans. There is a cap on what they can take out for undergrad, and it's actually based on each year that they are enrolled. So for the first year of, and actually, I think I have a good view on that in this slide. For anybody who might be curious, the you see a line here that says direct loan. And so if a student is a dependent, which really just means it covers most students, and it means that they're under 24, they're not married, they're not going to grad school, and a couple of other things. If they're considered dependent by the rules the Department of Education sets up, they're allowed to borrow up to $5,500 for that first year of school. That goes up a little bit in the future, so they can borrow 6,500 for their second year and 7,500 for each of their third and fourth years, and that's not changing. And they can borrow a little bit more. I can't remember off the top of my head what the total amount is for all of their undergrad through that loan
I think it's a
program,
little over
because
like 31,000.
I think it is 31,500 or
Yeah.
something like that. Yeah. Uh, but that's not changing. That stays as is. Uh, the only cap that's going to come into play here is really just what the parent is allowed to borrow on behalf of that student.
There's a question about dual degrees. You talked about dual degrees in terms of like graduate programs, but what about a dual degree where there is an undergraduate component combined with, a graduate degree, as a combined program?
It's a good question that we're looking into right now, especially for 6-year pharmacy degrees that are direct entry, and same on some of the nursing programs that are 6-year degrees and other. Uh, there's a little bit of a moving target around that. And so I honestly don't have a perfect answer to it yet, but it's a known open question. Oh, good question here. Can you take both a federal Parent Plus loan and a private loan on top of that to fill the gap? And yes, the same logic applies to graduate students. So, what I would expect to see this year is that quite a few parents will end up in a situation where they borrow the 20K from the Parent Plus product and then borrow the remainder of what they need from some private lender. Same thing is going to apply for graduate students, where even somebody going to a great dental school is more likely than not going to borrow $50,000 from the new federal and subsidized program, and the remainder of everything that they need from some other place.
Chris, there's some questions about, again, a little bit more about how Juno works. So somebody is trying to understand if they borrow through Juno, are they actually borrowing a private loan? That's one question. And then are there any sort of specific criteria that somebody needs to pass in order to borrow through Juno?
Yeah, good question. So, yes, it is a private loan. Uh, Anything that is not uh, the specific federal loans that you get from filling out FAFSA, or the Parent Plus loan that you get by filling out the Parent Plus application on the federal student aid website, is a private loan. And so I think still there are sometimes misconceptions about whether Sallie Mae or some other lenders are a federal loan or a private loan. They're all private loans. And so uh, federal is just going to be that direct loan for an undergraduate student that you'll see in your financial aid award letter from the school, or the Parent Plus loan that you again get directly from the Department of Education. And the second question about the requirements to qualify, it's a good question. The way to think of it is there's general underwriting criteria that are common across all of the different private lenders that exist in the market. And then there's a little bit of nuance and variation from one to the next. If you go to each one's private website and then their FAQ section, they'll typically say that the minimum FICO that's required to be eligible ranges somewhere from 650 to 660 to 680. It's going to change a little bit from one lender to the next. And beyond that, the more common eligibility criteria are around debt to income ratios, which I can't quote right now because it's quite a bit more complex than a number that I could give you. But all lenders on the private side will have to run through some basic math on determining whether the amount that you want to borrow and the monthly payment that you'll have to pay once you enter repayment relative to your monthly income, it falls within certain guidelines that they've set up themselves. That number is going to be a little bit different from one lender to the next. It's not something that even I have full access to. But what I can tell you is the key way to what I would do if I were in your shoes is to really just make sure to check what rates you might be eligible for on a few different lenders' websites that do not require you to conduct a hard credit check. When you do a soft credit check, you're still filling out a roughly 2-minute long form. It's going to ask you for a few bits of information, including your social security number. But that is not going to show up on your credit report. If it specifically says that it is a soft check, what that lender is doing is basically taking a snapshot of most of your information, but not all of it, and just telling you, are you eligible or not? And if the lender's process goes far enough to at least show you what you are very likely eligible for in terms of the rates and different options for loans that you could get. If you decide that you like anything that you see after you do a soft rate check, then you will typically have to submit a full application, which would take you a few more minutes. And at that point, it would result in a hard credit check. But the name of the game here really is to shop around with soft rate checks. And Juno is one of the places where you can at least see your rates, or at least if you are eligible, uh, without doing a hard credit check.
So, Chris, how about this as the last question? Somebody's asking, I don't know how specific you can get, but like what type of an interest rate would they get through Juno versus if they had applied to that same lender without going through Juno?
So it's a great question. I'll answer it in two ways. One, for graduate students, currently they're getting on average a 1.5% lower rate through Juno than going directly to the lender. And the actual magnitude of that discount is going to vary from one person to the next a little bit, but that is an overall average number that I'm allowed to share. And there are, on the refinancing side, people get roughly 0.25% lower rate going through Juno. On undergraduate loans, the way that we've actually set up the process was less about getting a specific rate discount that we could provide to you, and more about creating a process where if you'd get the same rates that you would normally get, except you get 2% cash back on the rates that of the loan amount. So a $20,000 loan, you'll get $400 back just for using Juno to process it instead of going direct. And if you find a lower rate from almost anywhere else, then you can very easily get that lower rate matched. And if you match a rate, then we increase that cash back to 3% of the loan amount. And so it's really meant to just create a process where you are more likely than not going to be better off going through Juno than through anywhere else.
Okay. Well, I had put previously in the chat a link to join Juno, but let me just say I understand that this was a lot of information for people to process and get their head around tonight, and it was not meant for you to kind of learn every detail right now. Luckily, we kind of have several months before people have to face the process of researching loans and making a decision. But it's good that I really just wanted to introduce you to these changes and a little bit about the process, and so that you're are not gonna what I tend to see happen is, having been a parent myself, I still am a parent and I've gone through the process and see a lot of other parents, is that it's over a year and a half or 2-year process between researching colleges with your students, going on visits, the whole applications. Now you're getting decisions back, and then your student finally makes a decision, and you feel like you can take this deep breath. And then all of a sudden, you're like, oh my God, there's another process. And that process is I got to figure out like what type of loans I'm going to get and how do I research loans. And people just don't expect that like type of process is coming. And it is actually also on a little bit of a condensed time frame because the loan rates don't come out until middle of June. You don't get your students, final costs for the fall, maybe until July, and then all of a sudden by August 1st, you got to pay the bill. So it's a short time period, and people don't recognize that they're going to have to do like more research and kind of make more decisions. So the one of the purposes of tonight was to kind of just give you a heads up about that there is more after your student makes a decision. That's for the families who are with current high school seniors. That will be over the next few months starting to talk more about this information and this process, so you don't get overwhelmed when you have to start it. And then for the families with juniors, that you're kind of aware as your student is making college lists and as you're researching and we always emphasize so much about understanding your family's budget and understanding what the finances are, and part of understanding what the finances are understanding what you can and cannot borrow. So that's the reason why we invited families with juniors here, so that you can start to understand at least the borrowing limits. You don't have to understand now the whole process and which loan is better and how you're going to research loans. But the most important thing for you was to understand what these limits are and how much your student can borrow, how much you as a parent can borrow, and just so that you factor that into your whole research. So just wanted to kind of give that background because I can imagine if I was a parent on the other end in, middle of January with my student as a high school senior, kind of listening to all this, and my head would be spinning. So I sympathize. I expect that your head might be spinning, but just understand that this is early information to start to kind of get you used to or aware that you're going to have to learn this information fairly soon. And with that, I don't think we have anything else tonight. Other than always feel free to reach out to me at Debbie@RhodesCollege.com, to Chris is it Chris at Join Juno, right, Chris?
It is, yes.
And truly, we've worked with Juno now. Is this going on maybe 5 years?
5 years, yeah.
Yeah. And they are a great partner. They are a great resource. And as Chris mentioned, they really do help one-on-one with families. Kind of if you have an individual situation to really, walk through the details and help you make a decision. So you will be seeing more of us over the next few months as we get closer to spring and definitely summer, where when families have to learn more and take actions related to loans.
Thank you, everybody, for being here. Thanks for sitting through some pretty dense topics. And yeah, as Debbie mentioned, if there's any questions that you have, my whole team is around to help you think through them. And you are very early on in the process right
Yes.
now, way earlier than almost everybody else is. So breathe a little bit of a sigh of relief. There's a lot more information that comes over the next couple of months, and you're way ahead of where you need to be to make the most use of that information.
Okay, everyone, good night. Go home, relax, and we will be seeing you soon.
Good
Take
night.
care. Bye.